Welcome back to Fast Money. Stocks riding a roller coaster after the Fed's interest rate decision this afternoon, with the S&P dropping 0.5% at its lows. The central bank raising concerns over stagflation, citing a more uncertain economic outlook, as well as a risk of higher unemployment and higher inflation. But major indices all rebounded off their worst levels, with the Dow gaining nearly 300 points. 10-year Treasury yields, meantime, back below the 4.3% mark. Let's get to Steve Liesman, who's got all the headlines out of the Fed today. Hey, Steve.
Hey, Melissa. Yeah, Fed officials maintain their holding pattern for monetary policy at that May meeting and suggested they could be on hold for a while longer until the fog from the economic impact of tariffs and other fiscal policies clear up. The Fed said in its statement that, as Melissa said, the risk of both higher inflation and higher unemployment had risen. That's the stagflation problem. Even while the economy continues to expand at a solid pace, unemployment is stable at a low rate and inflation somewhat elevated. Asked whether there had been any progress on the Fed figuring out which side of the inflation unemployment mandate it would most likely need to address, Fed Chair Powell said, still too early to say.
I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out, and also when they do settle out, what will be the implications for the economy, for growth, and for employment. I think it's too early to know that. So, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs.
So the market continued to price a July rate cut with some confidence at 70%, and two more cuts this year, one in September and then the other one in December. But that 23, or what is it called there on June, that there's a 23% probability on a June rate cut. That shows the market hearing the Fed loud and clear. June is still too early to know how monetary policy should be steered amid the profound changes and uncertainty that's coming from President Trump's tariffs. Melissa?
I thought what was sort of interesting was there's a question, I think, surrounding being preemptive. And he said we are not in a situation where we need to be preemptive, as opposed to saying we would not be preemptive. We would wait to see the impact in the data.
Well, the problem for the Fed being preemptive is preemptive on which side of the mandate. There was a nice quote from Jason Furman in the New York Times, who said, the reason why the Fed needs to be behind the curve is it risks being in front of the wrong curve, right? And the trouble is the uncertainty. They called it strategic uncertainty. I call it, I'm not sure if they know what they're doing, but in any event, on the tariffs, Melissa, if you go ahead and you cut interest rates because of the negative impact of tariffs, and then you have a situation where the president makes a deal and withdraws those tariffs, then the Fed could be on the wrong side, or it could be on the right side, depending upon what kind of impact of inflation comes through. I think we're just going to have to wait and see. And there's another danger here, Melissa, that is really hard to get your brain around, which is, what if you have a reaction first, for example, in the jobs market? Let's say those jobless claims spike, or we get them tomorrow morning, or the jobs market weakens, and inflation stays cool until later, when the retailers and the wholesalers pass along the tariffs. So you could be out there addressing the jobs part of the mandate, and only later do you find yourself with an inflation problem.
Right. What a pickle. Steve, thanks. Steve, Lisa, it really is. I thought that was a pretty good word.
Good use of pickle.
Yeah.
But where did that term come from?
I don't
being
know.
In a pickle.
Between a sandwich.
I don't know. Anyway, well,
Michael,
you could probably come up with better things than that.
I think we saw today that the Fed truly is a lagging indicator, number one. We have to see all the data before we do anything. It shows that, they don't really know what to do at the moment. I think Chair Powell was pretty upfront about that. The market did not tell you that there's a lot of stagflation risk. If you look at the long end of the yield curve, yields actually came down. The front end of the yield curve, yields didn't really move. That's the market saying the Fed's going to stay on hold for longer, and that's going to cause long-term growth and inflation to fall. Hence the long end of the yield curve, yields going down. That makes a lot of sense to me. I think they're going to have to wait to see what happens, as Steve mentioned, on the employment front, what happens on the inflation front, before they do anything drastic. My suspicion is they're going to hold for quite some time, and then they're only going to cut once they see unemployment jump substantially, and then you're going to get large cuts.
Right. That's what Michael Schumacher of Wells Fargo was on the desk yesterday, and he said back-end loaded 100 basis points at the end of the year, because it'll play out like that. All of a sudden, emergencies cut a lot.
Well, and also, I guess what I heard today is I heard more tension between the two parts of the mandate than I've heard in a long, long time, which tells me that, you know, if you want to believe in stagflation, I heard it as loud and clear as you could possibly have it. But Steve really communicated that dynamic. You move one side, you might be on the other side. So again, I think the tension between being focused on employment and being focused on inflation right now has both sides. They rose today.
Yeah, and I thought the comment about last year, the policy was restrictive or slightly restrictive, and that's why they cut 100 basis points in the fall. And obviously they were worried about jobs, and that was like, a big part of their mandate. But then he continually said that the economy is on decent footing, and he said it again and again, and he got asked a lot of questions about it. And I think the other way to think about this, if you're looking at it through the lens of the markets, is like, the policy rate was 5.5% for 2 years, and the stock market went up those 2 years 25%. The economy did not dip dramatically one way or another, but slightly weakening over the course of the last year and a half or so. So to me, I just don't know what the big rush is. Again, they are in a pickle. They have backed themselves in a corner. I don't think they backed themselves in the corner. I think the White House has backed themselves in the corner the way that they rolled out the trade war. I think there was a way that could have given them a lot more clarity about the path forward. And
just start QT though. That's the easiest way. That's just start QT instead, not QT off the balance sheet. If you stop that, because eventually when they start,
they continue to wind
roll
down.
off $35 billion.
I mean, that's a Fed that's feeling pretty confident,
right,
about tightening.
All right. Coming up, all the after-hours action, ARM Holdings, Zillow, Carvana, Dutch Bros, Flutter, all on the move after the reports and numbers from the quarters next. And speaking of earnings, Novo Nordisk getting a bump on the back of theirs. What's in store for their blockbuster weight loss drug? And what a phase out of compounded competitors will mean for the stock. You're watching Fast Money live from the NASDAQ market site in Times Square. Back right after this.